Hello everyone, welcome back to the Weekend Charts. Charlie Bilello here. A lot to discuss today. Huge show. We're going to run through Nvidia's earnings. We're going to talk about some market milestones, changes to the Dow, Amazon's in, Walgreens out, Nikkei back at an all-time high since 1989, and a lot more. So stick around to the end. If you're watching this on YouTube, hit that subscribe button for more content just like it. So let's start out with that huge Nvidia earnings report. Expectations extremely high heading into that report, and they beat expectations once again. Pretty incredible. The revenue for the quarter, 22 billion. Expectations were for 20 billion, so handily beating that. And their guidance for the current quarter, 24 billion. That was above expectations as well. And if we're looking at Nvidia over the last 10 years, from 1 billion in quarterly revenue to 22 billion. Just an incredible growth story. We've never seen anything like it for a company this size. And in terms of the growth rates here, 265% year-over-year growth in terms of revenue. If we're using that 24 billion projection for the current quarter, we're going to start to see finally that growth rate decelerate a little bit down to 234%. But again, that was ahead of expectations in terms of what their guidance was. So if we're looking at net income, the bottom line, huge beat there as well. 12 billion now in net income. That's a 769% increase over the last year. And in the last decade, 83 times higher in terms of their net income. What does this mean in terms of profit margins? Another record high. So despite the fact that they're growing the top line at an enormous rate, they're able to not only maintain profitability in terms of their profit margins, but actually expand it. That shows you how high the demand is for these chips, that people are willing to pay pretty much anything here. We're looking at 56% in terms of the net profit margins for Nvidia. That's another record high. And so how did investors receive this report? Well, they seem to love everything about it. Nvidia's stock price jumped 277 billion in terms of market cap. That was the biggest single day gain of any stock in the history of the US market. It actually surpassed Meta. If you remember a few weeks ago, after Meta reported, they gained 197 billion. So handily beating that in terms of the largest single day increase in market cap. And what are analysts expected going forward? Where they're expecting growth rates to continue here for Nvidia. They're looking at 2026 fiscal year revenue of 110 billion. That would be up from 60 billion over the past year. So looking essentially almost a double from here in terms of Nvidia's revenue over the next few years. So looking at the stock market, and we talk about story stocks, and for a long time in 2020, 2021, Tesla was clearly the story stock of the market, but Nvidia seems to have replaced Tesla as the number one story stock. And we could see that here in options activity, just enormous options premium spent on Nvidia calls and puts, mostly calls, over 20 billion last week. That was higher than the combined total for the other members of the Magnificent Seven. So if we look at Tesla, Meta, Apple, Microsoft, and Amazon, we add them up together and they don't equal what Nvidia's options premiums were for the past week. So incredible activity there in terms of speculation from investors. So if we look at the Magnificent Seven, the past few years, Nvidia far and away the leader. So 2022, that was the bear market year, and we saw declines across the board for the Magnificent Seven. Last year, Nvidia comes soaring back, first one to hit new highs. And if we look at the combined total here, Nvidia up 168% since the beginning of 2022. At number two would be Meta at 44%. We could see the S&P 500 up 10% over that period of time. And actually Amazon, Apple, Google, and Tesla actually underperforming the S&P 500 since 2022. I think that would surprise a lot of people because of the constant focus on the Magnificent Seven. And yes, returns have been incredible in 2023 and 2024. But if we include 2022, a number of these members are actually underperforming the S&P 500. But if we look this year, so far, it's kind of a continuation of last year in terms of the top two stocks in the S&P 500. Number one and number two in 2023 were Nvidia and Meta. And so far this year, Nvidia, number one, up 59% already in 2024, and Meta up 37%. So just stunning, stunning increases. And if we look at the outlier in that Magnificent Seven, definitely Tesla here among the worst performing stocks in the S&P 500, down 23%. So let's talk about the broad market. The enthusiasm over the Nvidia report really pushed the market up to new highs. Once again, we had the S&P 500 hit its 13th all-time high of the year. And if you're wondering if this is a more than usual, yes, for sure. We're looking at through February here. If we project that out over the end of the year, it would actually surpass 1995 in terms of the number of all-time highs. That would be the most in history. And of course, it's not expected to continue at this pace, but that just shows you how frequently it's been hitting all-time highs in the first 2 months of this year. And we saw the S&P 500 hit another 100-point milestone last week, 5,100, crossing above there for the first time. So it took a long time to get from 4,800 to 4,900 because of that bear market. But since then, hit 5,000 very quickly, 15 days, and 15 days after that, hitting 5,100. If you look at the Dow, 39,000, similar thing. It took a long time to get from 36,000 to 37,000 because of that bear market. And now we've hit 38,000 and 39,000 very quickly. And if you notice here, as we go up here in terms of 1,000 point milestones for the Dow, it becomes easier to achieve these because the percentage increase is lower and lower. So at some point in the next 20 years, we're likely to see the Dow hit 100,000. That seems like a high number, but again, the percentage increases from here are going to be smaller and smaller. So at some point, you're gonna see 1,000 points, pretty much volatility in normal trading day as this continues. So just the nature of the numbers here. If we're looking at the Dow specifically, a change here in the components. Amazon was included in the Dow. Walgreens was kicked out. Kind of interesting here that the Dow committee, the people that select the components of the Dow, waited this long to put Amazon in. It only took 178,000% return for Amazon since its IPO in May 1997. But I guess that was finally enough for the committee to say we can't leave Amazon out any longer. They put Amazon in. They pushed Walgreens out. Why did they kick Walgreens out? Well, it's been the worst performer in recent years. It actually declined 58% from when it was added in June 2018. And it actually replaced General Electric at the time. And General Electric, if we look at the return over that same period of time, was actually up 86%, which is kind of interesting, but not unusual. We tend to see actually mean reversion in terms of the Dow. When you add a component to the Dow, it tends to underperform for a period after adding it. And when you remove it, actually tends to outperform. There's been a few studies on that. And we saw that here with GE and Walgreens. So we'll see what happens with Amazon and Walgreens. Maybe Walgreens gets a rally after being replaced, and maybe Amazon has a little bit of mean reversion to the downside. We'll see. But in terms of the Dow, it's a kind of a fascinating index because it uses this price weight. So most of the indices in the market, if we look at the S&P 500 or the NASDAQ, almost all of the major indices other than the Dow use a market cap weight index. And the Dow is just looking at actually the price per share, which is pretty much meaningless, but it uses that and it just looks at what the price it's trading at, and it weights each component based on that. And because of that, you have these kind of weird things where something like United Health Group is the largest component in the Dow at 8.8%. And if it was based on market cap, it would only be 3.4%. And where you see a big difference is in terms of big tech, where Microsoft and Apple have a much lower weighting than they would have if we're using market cap. You got Microsoft at 6.8%, and you have based on the price weighting, and 21% would be its weighting if it was based on market cap. So Amazon's actually only the 17th largest component in the Dow. If it was based on market cap, it would be the third largest. And so a huge spread in terms of underrepresenting Amazon. But kind of fascinating that this is still the methodology for the Dow. And I think even more fascinating is the fact that it remains highly correlated with the S&P 500, and it has actually outperformed the S&P 500 in terms of the Dow ETF started in January 1998, and since its inception, it's outperformed the S&P 500 up 767%. So despite this ridiculous methodology, it's still outperformed the S&P 500 over this period of time. And I guess part of that is just replacing these components. Part of that is the fact that as prices go up, it is somewhat reflective of the winners increasing in weights. But the crazy thing is when a stock splits, the weight goes down. So for example, here Walmart's at 1%, and just a few days ago it was at 3%. The reason for that is it split 3-for-1 in terms of its share price. So just a weird, quirky index that people still pay attention to, still gets attention, but this price weighting is absolutely crazy. You can think of any number of things that would be better to weight an index by in terms of revenue or in terms of profitability, net income, but they decided to use price, and over the past 20 plus years, it really hasn't hurt investors if you pick the Dow over the S&P 500. Now, let's talk about the Nikkei here. Fascinating example here of sentiment and how sentiment can get to an extreme and how the market is not always right. So that's saying the market's always right. You can always trust that the prices that the market's reflecting are rational, and that simply is not the case. And the reason for that is because investors are not rational, and at extremes they're very much irrational. And we saw that in December 1989 when the Nikkei was arguably one of the biggest bubbles in the history of financial markets. When it peaked in December 1989, it took now over 34 years for it to get back to a new all-time high, but it's finally there. There was an 82% drawdown from that 1989 peak. It didn't bottom until October 2008, and since then it's rallied 459% to get back to new highs. Now, if we look at the Nikkei in terms of valuations back then in 1989, a 78 CAPE ratio. And just to give you an idea of how high that is, at the dot-com bubble peak for the US peaked at 47. So extreme sentiment in terms of people thinking that the growth for Japan was going to be enormous over the next few decades. And it actually was the exact opposite, had very slow growth. And therein lied the problem. And that's why it took 34 years for the index to get back to new highs. Now, the US index in 1989 was actually trading at 18, so not very expensive at all. And the big lesson for investors here is not, as many say when they look at Japan, that you shouldn't invest because you can go a few decades without hitting a new high. The lesson is to diversify. When you see a bubble, when you see something that's irrational and extreme, diversify away from that bubble. And if Japanese investors have heeded that notion back in 1989, they would have been served very well by investing abroad and looking at the US stock market. Since the Nikkei peaked in 1989, it's actually increased 2,800%, 10.4% annualized return. So let's talk about the economy. The U.S. recession calls, well, at least one major company here called the Conference Board is calling off their recession, and that's in spite of the fact that their leading economic index is actually down now 22 months in a row, which is the longest down streak since 2007 to 2008. The Conference Board had been predicting a recession for some time. They started predicting it in the first quarter, actually, of 2023. Then they pushed that back to the second quarter of 2023, then the third quarter of 2023, then the fourth quarter. And then when it didn't happen, they pushed it back to this year to first quarter and then the second quarter of 2024. And now with their latest release, they're actually calling off the recession. The reason why they're saying is that 6 out of 10 of their leading economic indicators here are positive over the last 6 months. So apparently when it crosses the threshold of 5, so you have more than half of the components showing a positive increase over the last 6 months, they no longer forecast a recession. You can see the U.S. stock market here, the S&P 500, being the leader in terms of the upside. So pretty fascinating in terms of predicting recessions. Very, very difficult business, as we always say. But this leading economic index that historically had been pretty reliable And if you look back in the past few recessions, when this thing turned down, you had a recession follow not long thereafter. Well, this time, so far at least, seems to be different. So we'll see if they change their mind again. If these things turn negative, I guess they would have to change their mind again and start predicting a recession. But it just illustrates how difficult not only predicting a recession is, but getting that timing right. And this is no different than any other forecaster trying to predict these things. You can use any number of leading indicators, but these leading indicators change with time. The lag times change, and it's not foolproof by any means. Now, the interesting thing we have here is the yield curve continues to be negative in terms of this leading indicator. And as we talked about, it's a very long leading indicator. So where we are today, it first inverted back in October 2022, and we're not even 2 years past it. And the average is about 2 years from that first inversion when you see a recession begin. So we'll see as the year goes on if the conference board flips back to a recession, but this should be a textbook example to illustrate how difficult it is to predict a recession, and that as an investor, you really have to ignore these recession calls, because getting that timing right in terms of investing, well, they started predicting the recession back in 2022. That was actually the low for the stock market. So ignore these forecasts because nobody can get it right with any kind of consistency. So let's talk about Rivian and really the new reality in the market. Rivian was one of the leading mania examples that I illustrated back in 2021. It went public November 2021, right near the peak in terms of EV enthusiasm. And you just had this crazy situation where it was losing billions of dollars at the time and actually had a higher market cap than both Ford and GM at the time for a brief moment in time. I wrote about it, said this is absolutely insane. It's assuming that Rivian is going to have just this growth in vehicles that is enormous over the next decade without any problems. Well, all of a sudden, the problems have arisen. This is a crazy stat. Rivian's still losing money today, but it's actually losing $43,373 for every vehicle that it sold in the fourth quarter. Just a crazy, crazy stat. These are not cheap vehicles. They're very expensive. I mean, they're selling for $70,000, $80,000, $90,000, these vehicles, but they're losing $43,000, showing you that the cost to produce them is extremely, extremely high. So crazy thing about Nvidia, it was losing money back then. Investors just didn't care about it when it went public because you had this mania. Profits don't matter. All that matters is the growth potential. The growth potential is viewed as enormous. Well, today they're losing money, and investors seem to care about that very much. We can see this in terms of market cap, peaked at 153 billion back in November 2021. It's now down 94% to where it is today at 9 billion. So a big lesson for investors here, that investors can be very, very irrational at bubble extremes. And this definitely was a bubble at the time because it was assuming just growth that was astronomical. It was assuming that everything would go right for this company that had barely produced any vehicles at the time. So if we look at Rivian on this list here, it's not alone. You can see I put together a list of the leading EV companies around the world, and a lot of them are down 90+%. So it's not just Rivian. If we look at things like NIO, which is a very popular stock, we look at Lucid, 95% decline, Nikola, 99% decline. It's surprising to me that that hasn't gone bankrupt yet, and on and on and on. Some of them have. Lordstown has gone bankrupt, and so has Proterra. But just stunning, stunning declines, and what a change in sentiment in terms of where we were in 2021 versus today, where profits matter again, and many of these companies are not only losing money, but losing a lot of money. It turns out it's not as easy as investors assumed to be profitable in terms of being an automaker, and EVs are expensive to make. And thus far, many of these companies haven't proved that they can make a profit from it. So if we look at the ramifications of the EV decline and the fact that expectations for growth were much higher than what actually transpired. We can see this in the price of lithium. Of course, lithium batteries are used in EV vehicles, and the price of lithium here is now down over 80% from its peak. So you just had just a huge amount of mining oversupply in terms of the expectations, and now they're not selling as many EVs as they expected. They don't need as much of this material, so we're seeing the price normalize. It's a great example of market forces going to work here and providing that lower price. And we're now back to mid 2021 prices in terms of the price of lithium. So just fascinating to see that. Let's talk about the housing market. Nothing new here. The stagnation continues. We have existing home sales down 2% over the last year. Not a huge decline, but it's the 29th consecutive year over year decline. That's the longest down streak we've seen since 2007 to 2009. If we look at the absolute level of activity here, 4 million on a seasonal adjusted annual basis. That's still lower than what we saw during the COVID lows, where no one was going out and transacting. So just very, very low activity in the housing market. And the biggest reason for that continues to be the lack of affordability. Mortgage rates are at year-to-date highs. They moved up back up to 6.9%. That's just crushing affordability. And if we look at supply, it remains very, very low. And the result of that is that prices are not going down and helping affordability. They're actually still going up. On a year-over-year basis, we're seeing the median price of an existing home actually up 5% over the last year. So housing market, perhaps we're getting closer to some type of bottom in terms of maybe this year-over-year percentage is going to start flip to a positive. But it seems like we need something to happen, either mortgage rates to come down or prices to come down to really change that affordability picture and really lead to a pickup in activity. So I want to end, as I always do, with something positive, and huge positive for people that are looking for cheaper cars is the fact that the used car market continues to normalize. I called it the used car bubble back in 2022. We just saw crazy prices across the board for used cars, just a irrational level in terms of the prices. And now we're finally seeing some relief here. This is the Manheim used car index I'm showing you here. It's at its lowest level since March 2021. That's down 22% from its peak. So great sign there. And the good news for people that are looking to buy a car is this is a leading indicator of retail prices. So you tend to see this go down, and then you see retail prices follow on the downside. And we're definitely seeing that across the board, and particularly in the average price of a used Tesla, which is declining now for the 19th month in a row. It's actually down now 52% from its peak. 67,900 was the peak average price for a used Tesla. Now you're at 32,900. So if you've been waiting for Tesla to buy a Tesla to become more affordable, it's definitely getting to that place. It's actually not that much above now the average price of all used cars. So it went from trading at a huge premium, over 30,000 higher than the average price of a used car, to almost at parity. And if this continues at this pace, it won't take much longer before that crossover occurs. So great news for consumers. If you've been waiting to buy a car because they've been too expensive, the price is coming down. Yes, interest rates remain high, so if you're financing it, it's still going to be difficult. But the fact that prices have come down and look like they're going to continue to come down is absolutely great news. So we'll end it right there. Have a great week, everyone, and I'll see you next time on the Week in Charts.